Let's set the scene. It's December 2025, and India's biggest airline, IndiGo, is in an absolute freefall. Now, what the headlines were calling an operational headache was actually something much, much deeper, a catastrophic financial meltdown. We're going to break down exactly how this happened, and we'll be using this 7-layer framework from IR4X Solutions to do it. It's a really cool way to see the hidden cracks that brought a giant to its knees. This is a story about the incredibly high cost of being unprepared.
So, what's the big mystery here? How can a seemingly tiny regulatory update, something that just changes pilot rest schedules, somehow end up igniting a 2,500 crore rupee financial firestorm? It's a fascinating look at hidden risks and, well, the brutal price of getting caught off guard.
Okay, to really get our heads around the mechanics of this crisis, we're not going to start with complicated spreadsheets. Nope. We're starting with the simple story I like to call Riya's piggy bank. So, this is Riya. She gets her pocket money every week in rupees, but the one toy she wants more than anything is from the USA, and it's priced in dollars. Pretty simple, right?
But here's her first problem. The rupee starts to get weaker against the dollar. All of a sudden, that toy gets more and more expensive for her. The price tag in the US hasn't changed at all, but for Riya, her dream is slipping away. That, in a nutshell, is foreign exchange risk.
And just when she thinks it can't get any worse, bam, a second shock hits. Her parents cut her pocket money by 80%. So now her income has collapsed at the exact same time her costs are spiraling up. It's the perfect storm for her poor piggy bank.
And believe it or not, this little story perfectly explains IndiGo's exact situation. Just like Riya, IndiGo earns its money, from all of us buying tickets, in rupees. But its biggest bills, we're talking multi-million-dollar airplane leases and jet fuel, they're all paid in US dollars. So they got hit with that same devastating 1-2 punch, a currency shock and a massive income shock, all at once. All right, now let's connect the dots and see how that 1-2 punch spiraled into a perfect financial storm. This is where we see how these different shocks didn't just add up, they actually multiplied each other's destructive power.
What's so wild about this is you can literally watch the dominoes fall. It all kicked off with that operational shock. Over 1,000 flights canceled. That immediately tanked their daily cash collections. This strain then forced them to go out and make emergency buys of US dollars, right when the FX shock was making those dollars painfully expensive. And of course, the market smells blood in the water. Vendors start to panic, and a tidal wave of refund requests just makes everything infinitely worse. A total textbook chain reaction. And here's the damage report from just 5 days. You can really see the compounding effect in these stark numbers. The loss from ticket collections was a massive 2,005 crores. The flood of refunds added another 342 crores, and the currency hit tacked on another 153 crores. So the key thing to get here is no single one of these was a fatal blow, but together, they punched that nearly 2,500 crore hole right through their balance sheet. Okay, to really nail this down, let's quickly define a few key terms. First up, FX exposure. This is the fundamental risk you have when you earn money in one currency, say rupees, but you have to pay your biggest bills in another, like US dollars. For any international airline, this is a massive constant vulnerability. So, how do you protect yourself? Well, you use a strategy called hedging. Think of it like buying insurance for your currency. You lock in an exchange rate today for a payment you have to make way down the road, and that shields you from any crazy swings. Now here is the absolutely shocking part. IndiGo had only about 8% of its exposure hedged. Just 8%. And the final piece of the puzzle is the liquidity buffer. This is your rainy day fund, your emergency cash reserve. We measure it in cash runway. Basically, how many days could you survive if your income dropped to zero? IndiGo's runway was just 18 days. I mean, to put that into perspective, most global airlines shoot for 90 days or more. Their safety net was dangerously thin. So when you put all this together, it paints a picture of two completely different realities. To see what I mean, let's imagine we're a fly on the wall at the 9:05 a.m. morning briefing at two different airlines during this exact same time. The contrast is just night and day.
In the IndiGo crisis room, the CFO is asking a question of pure survival. How many days of cash runway do we have if this continues? You can just feel the panic in that question, right? It's all about just trying to make it through the next 24 hours.
Meanwhile, at a resilient competitor, think of a Lufthansa or a Singapore Airlines, the CFO is calm, strategic, and looking ahead. Their question is,
Are we positioned for the next rate cycle? They aren't worried about surviving. They're already scanning the horizon for the next opportunity. And this table just lays it all out, black and white. An exposed airline like IndiGo has almost no hedge coverage and a frighteningly short liquidity runway. Their systems are reactive, always a step behind. Their main worry is just survival. A resilient airline, though, high hedge coverage, a huge cash runway, and proactive systems. Their worry isn't survival, it's optimization. They're playing a completely different game. So, how does a company pull itself back from the brink of a disaster like this? Let's walk through the recovery blueprint. How do you build a treasury that's actually resilient enough to handle the next big storm? The first 4 weeks are pure triage. It's all about immediate stabilization. You get emergency credit lines to buy yourself some breathing room. You activate a basic hedging program to stop the bleeding. You roll out a simple crisis dashboard so you can actually see what's happening in real time. And you create a payment waterfall, which is just a fancy way of saying you have a clear plan for who gets paid first when cash is tight. It's all about regaining control. But look, true resilience isn't a quick fix. It's an 18-month transformation. The first 3 months are all about laying a solid foundation with modern systems and real policies. The next 6 months, you focus on automation, getting real-time data to flow without anyone having to lift a finger. And the final stretch is all about optimization, running regular stress tests to find the weak spots, and, this is critical, making sure everyone's incentives are aligned to maintain that resilience. It's a marathon, not a sprint. Ultimately, this entire story boils down to one of the most fundamental strategic choices any business leader has to make. Are you building your company for maximum efficiency, or are you building it for resilience? On one hand, you have the efficiency-optimized model. It delivers fantastic profit margins when the sun is shining, but it's incredibly fragile. It can shatter in a crisis. On the other hand, you've got the resilience-optimized model. Yeah, your margins might be a little lower in the good times because you're paying for that insurance, but when a crisis hits, you don't just survive. You can actually thrive and grab market share from the ones who didn't prepare. And that brings us to the final, crucial question that this whole thing is really about. It's a question for every leader, every entrepreneur, and every manager out there. Is your business built for good times, or is it built for all times? The analysis we've walked through today is based on that 7-layer framework we mentioned at the start, which was developed by the experts at IR4X Solutions. It's a really powerful lens for seeing how even the smallest hidden cracks in a business can lead to a catastrophic collapse.